There's a woman named Teresa in Columbus, Ohio, who drives a newer Honda Accord, has a LinkedIn profile with a job title that sounds important, and shops at Trader Joe's on Sundays. She makes $74,000 a year managing logistics for a mid-sized company. And 3 weeks ago, she walked into a pawn shop for the first time in her life, set her grandmother's diamond ring on a glass counter, and walked out with $310 in cash. She told the man behind the counter it was temporary. She wasn't lying, but she also wasn't being entirely honest with herself about what temporary was starting to mean. My name's Daniel, and what I want to talk about today isn't really about pawn shops. It's about what pawn shops are quietly measuring that almost nothing else in our financial system is willing to look at directly. Because here's the thing, when you look at a stock chart right now, everything appears healthy, green, climbing, optimistic. But there are other measurements happening in the background, in strip malls and suburban storefronts, that are telling a very different story. And the gap between those two pictures is the most important financial tension in America right now. Let's start with something that doesn't get talked about enough. There are entire categories of financial behavior that never show up in the data Wall Street watches. When Teresa walks into a pawn shop, that transaction doesn't get logged into any consumer confidence index. It doesn't move the retail sales numbers. It doesn't register in the Fed's models. It's invisible to the dashboard. But it's not invisible to the pawnbroker behind the counter, who has spent decades watching the same human pattern play out in different faces. The stuff people bring in tells him everything, not just what they own, but what they're willing to part with, and for how long. Here's what's actually happening inside these stores right now, and it's more financially revealing than most quarterly earnings reports. The average pawn loan in the United States has grown by nearly 50% over the last few years. That number sounds like growth, like prosperity even, but read it differently for a second. It means the average person walking in needs substantially more cash than they used to. The emergencies are bigger. The gaps between income and reality have widened enough that a few $100s no longer covers it. And the stores are busier than they've ever been, not with down-on-their-luck strangers from some other side of town, but with people who look exactly like Teresa, people with jobs, people with functioning lives, people who, until recently, would have said a pawn shop wasn't something they'd ever need. Now here's the detail that I keep turning over in my mind because I think it contains more truth than most financial headlines. Around 80 to 85% of people who take out a pawn loan actually come back and pay it off. They reclaim their ring, their tool set, their laptop. So this isn't a story about people who have completely lost their footing. It's a story about people who are managing, just barely managing, on a kind of financial tightrope where one unexpected month tips the balance. The pawn loan is how they hold the rope a little longer, and the fee they pay to do that, which can run at an annualized rate somewhere between 80 and 200% depending on the state, that's just the cost of surviving a bad month in modern America. If you're finding this kind of honest breakdown useful, take a second and subscribe. This is exactly the kind of story I try to bring every week, the stuff that doesn't make the front page but matters more than what does. Now let's go upstairs because the contrast up there is almost surreal. The stock market in early 2026 is sitting at valuations that, by historical standards, are extraordinarily expensive. There's a metric called the Shiller-Cape ratio that strips out short-term earnings noise and gives you a longer view of how pricey the market is relative to its actual earnings power. Right now, it's sitting near levels that have only been exceeded once in modern history, just before the dot-com crash. And here's the part that doesn't get said enough.
The people driving those valuations aren't really buying the economy. They're buying a relatively small number of enormous technology companies whose revenues come from all over the world and whose profits are largely disconnected from whether Teresa in Columbus can afford her car payment. The stock index and the American household are tracking two very different realities, and we've been treating them as the same thing for so long that the confusion feels normal. What makes this particularly strange is that both things are true simultaneously, and neither cancels out the other. Corporate earnings can be strong, while personal savings rates collapse. The market can hit records, while subprime auto loan delinquencies exceed levels seen during the 2008 financial crisis. That's not a contradiction, it's the actual shape of the economy right now. The aggregate number looks fine because a smaller group at the top is doing extraordinarily well, and their spending is large enough to pull the average up. But averages are liars when the distribution underneath them is this uneven. A room where one person has $1 million and 9 people have nothing averages out to $100,000 per person. That average tells you almost nothing useful. Here's a behavioral angle that I find genuinely fascinating and almost nobody talks about. When people start feeling financially squeezed, they don't usually announce it. They don't post about it. They quietly reshuffle. They switch from the brand name pasta to the store brand. They cancel the gym membership and tell themselves they'll run outside. They stop contributing the full amount to their 401k and tell themselves they'll catch up later. These are all quiet, private adjustments that don't show up in any public data, but they're the financial equivalent of a building slowly settling into softer ground. Nothing looks wrong from the outside until suddenly something does. The pawn shop catches what all of those invisible adjustments miss, because at some point the reshuffling runs out of room. You've already cut the subscriptions and switched the grocery store and put the vacation on hold. And then something breaks: the car, the furnace, the medical bill. And you need cash in 48 hours, not in 2 weeks when the bank would process a personal loan application. The pawn shop exists in that exact 48-hour window. It's not a poverty story, it's a liquidity story. And liquidity is tightening for a much wider slice of the American middle class than the market's record highs would suggest. Let me give you a number that puts this in concrete terms. The personal savings rate in America recently hit 3.6%, meaning the average household is saving less than 4 cents of every dollar they earn. For context, a healthy savings rate is typically considered to be somewhere in the range of 8 to 10%. At 3.6, there is almost no cushion. There is no buffer between a normal month and a crisis month. And when there's no buffer, small shocks become big problems very quickly. A $700 car repair doesn't get absorbed. It gets financed, deferred, or it turns into a visit to a pawn counter with something valuable in hand. What I find most psychologically interesting is how invisible this stress is, even to the people experiencing it. Teresa doesn't think of herself as financially fragile. She has a job and a car and a retirement account that's technically growing. The account balance is up, the market is up. She reads the same headlines everyone else reads about record markets, and she thinks she's doing okay. But her savings buffer is gone. Her fixed costs have crept upward every year without her quite noticing, and now a single bad month is enough to send her to that counter with her grandmother's ring. The psychology of financial fragility is that it doesn't feel like fragility until the moment it breaks. This is the thing pawnbrokers understand that most economists don't spend enough time on. Money stress is almost always a timing problem before it becomes an amount problem. People aren't broke in the sense of having no income. They're broke in the sense that their money arrives on a specific schedule, and their expenses don't respect that schedule. The rent is due on the 1st. The paycheck arrives on the 15th. The medical bill came last Tuesday. The math eventually adds up, but not always in the right order. The pawn loan is a timing fix. It bridges the gap between when the expense arrived and when the income will. The cost of that bridge is enormous, but the alternative, missed rent, a shutoff notice, a repossession, feels worse in the moment. So what does all of this actually mean for how you think about your own financial position? Not in a generic build an emergency fund way. You've heard that before. I mean something more specific. The margin between fine and not fine has quietly shrunk for most American households over the last 6 years, and most people haven't fully noticed because the market is telling them everything is okay. The market is a forward-looking opinion. The pawn counter is a present tense measurement. They're measuring different things, and right now they disagree sharply. That disagreement is worth paying attention to, not because a crash is coming tomorrow, but because the absence of a buffer is what turns a manageable problem into an unmanageable one. The storm doesn't have to be historically large if there's no roof. Before you go, I want to leave you with something to actually sit with.
Teresa will probably get her ring back. The odds are in her favor. But the month that forced her to put it down in the first place, that's not going away. The structural squeeze that made the timing not work, that's still there. And if the timing doesn't work next month either, the ring might not come back. That's the line the market can't see from where it's sitting. If this kind of financial storytelling is something you want more of, subscribing is the best way to stay connected to it. I try to bring one of these every week. And I want to leave you with one genuine question. When was the last time you actually calculated how many months you could survive financially if your income stopped tomorrow? Not guessed, actually ran the number. Drop it in the comments. I think the answers might surprise all of us.